Hey, this is Danielle, and today I'm going to be showing you an example of an SPX 0 DTE day trade. This is a trade that I did the last hour before the market closed, and I went ahead and let it cash settle. I did this trade because today was a little bit of a lackluster day. We had a little bit of back and forth price action. There wasn't really too much going on with the market internals, and so I decided to just place a neutral trade and sell premium to capture premium decay for that last hour of the trading day. So let's go ahead and look at the example. Here's a screenshot of what it looked like in my options chain when I originally got into the trade. So I call these iron condors, and the reason why I call them that is because in Thinkorswim, that's actually what the trade setup is called. I know a couple people have pointed out, oh no, it's an iron butterfly, but that's not an option in Thinkorswim. So just call it iron condor. It's easier for me when I'm teaching. People can follow along easier with the same platform. But essentially what this is it's a strategy where you come in and you sell the at the money calls and you sell the at the money puts, and then you buy some outer wings for protection. In this case, this is a screenshot of when the S&P was trading right around 5,300, which I had identified as the sticky point because there was a lot of high open interest. If you look at the volume in the open interest, you'll see that at that strike, there were 90,000 contracts trading at that 5,300 strike versus 58,000, 49,000, 41,000. So, if you can get about double, generally triple is a little bit better, but double the spine, that just creates this nice sticky point. And so if you can come in and you can sell that premium when the ticker is trading right around that zone, that's when you're going to get the most equal risk to reward. So in this case, these calls were still going for 320. The puts were going for 360, creating a neutral trade. I went ahead and made this trade $10 wide. So I bought the 53.10 calls for protection, and then I bought the 50 to 90 puts for protection. You can see that on the screenshot at that time, there was a $7.87 expected move. So to get $5.40 of premium was pretty good. It's obviously not going to be the exact same as the expected move, but you're basically saying, the market makers are pricing in a $7 expected move. I can get $5.40 of premium. Is it going to move more than that into the last hour of the day? Probably not, because the market internals are showing that we're just getting a lot of chop going on. So that was the idea behind the trade. If you look at the screenshot of my risk to reward, I was originally, I couldn't get filled at this price. I ended up getting filled a little bit lower, but originally when I was getting into the trade, my risk to reward was a little bit better than 1-to-1 because my max loss was going to be about $465. My max profit was going to be about $535. So in these kinds of trades, generally I'm going for about 50% of the credit. So if I sell it for $5.40, trying to buy it back around 250, 275, that would be a good 50% decay. Sometimes you can get a max profit, which is great. If it pins exactly at 5,300, it didn't do that today, but I got about 40%, which I'm happy with. So I generally risk about $500 per trade on these kind of day trades at the end of the day. So that's what I ended up doing. So let's go and I can show you how this played out. All right, so let's look at the results. At the end of the trading day, we ended up with a profit of about $207 on this trade. That was about 42%. So essentially what happened was I ended up getting filled at $4.90, which was a little bit lower than what I was trying to bid, but that's okay. So I sold that $4.90 premium, and then over the course of the hour, that decayed. And then at the end of the session, it was worth $2.82. This isn't 100% right because you have to look and see what the final settlement price is. You have to check with your broker to see if there's any kind of fee that they charge you for not closing out the trade. But in general, these are going to be cash settled options. So you actually don't need to close it because you're not going to be assigned any kinds of shares or anything like that. And in this case, I was sitting here, I was watching the trade, and I could have closed it, I don't know, maybe a couple minutes before, and it was up a little bit more. I was making about $300 at one point. But the thing about these trades at the end of the day is that the whole point of them is you're trying to capture that decay and you're trying to capture that chop. Looking at the market internals, I can show you what I was seeing. We had a situation where the ticks were trading back and forth between negative 600 and positive 600 pretty much all day. And for the most part, they were actually staying between negative 400 and positive 400. So, to me, that's a really choppy day. It is typical to see a little bit more buying or selling that last 10 minutes of the session. So if you get a little bit nervous on these, or you're already making 40 or 50%, you can just close out the trade, and then you don't have to worry about, where exactly it's going to cash settle. And I could have done that, but I just let it cash settle. So looking at this, you did get just a tiny little bid there right at the end of the day, which ended up bringing us just slightly higher. It kind of broke us outside of this range. This is an S&P futures chart on a 5-minute. We had some pretty choppy price action. We ended up getting a little bit of a sell-off. I got into the trade right about here. So once we got right back to the chop zone, I got in there. Like I said, it did end up trading a little bit higher, and then that burst at the end of the day ended up sending the SPX just a little bit higher up above my 5,300 penning price. But it was still just enough to where I could still capitalize on that theta decay. So I think it was a good trade. It was a nice little easy trade at the end of the day. It didn't really require too much effort. These kind of trades aren't the most exciting trade in the way that you're coming in and you're saying, oh, I'm going to capture 50 points of upside in the S&P. But the thing is that as a trader, you have to trade what the market can give you. And sometimes what the market gives you is chop. And so when you notice that you have the index and it's trading right around a key psychological value, that's a sticky point. There you have it. That is my 0 DTE SPX trade. This is a neutral premium selling trade in the options market. If you want to learn more, check out the links below. You can learn how to join me in the trading room on Twitter and more. And I'll see you in the next one.